Think making more money makes you rich? Think again. Welcome to Finances with Finn, where we expose money mistakes before...
Hey everyone, I'm Finn, and welcome to Day 6 of our series Index Funds for Beginners. In today's explainer, we are tackling what is, without a doubt, the most intimidating yet absolutely crucial wealth-building tool in existence. And we're going to start things off with a massive pattern interrupt. Think about it. Pretty much everything you've ever been told about getting rich in the stock market probably involves frantic trading, secret insider tips, and trying to somehow outsmart a rigged system, right? But what if the real secret is entirely different?
Take one of the greatest investors in human history, Warren Buffett. He left very explicit directions for his own family's money for after he's gone. And you know what's crazy? He didn't recommend his own hand-picked stocks. He didn't point them toward elite, closed-door hedge funds. His instruction was surprisingly, almost shockingly simple. He literally wrote, put 90% of it in a low-cost S&P 500 index fund. The man who famously beat the market for decades explicitly told his own family not to even try picking stocks. Instead, he told them to buy the absolute most boring thing possible.
Section 1. The secret to wealth, buying the racetrack. Okay, let's dive right into this. Because to understand exactly why the greatest stock picker alive gave that advice, we really need to understand what this boring vehicle actually is. At its core, an index fund is brilliantly simple. It is essentially a single basket holding an entire list of companies, all in one single purchase. Look, buying one individual stock means you are betting your hard-earned money on one specific company, which, let's be honest, is incredibly hard to get right. But an index fund, it says, don't pick, just buy all of them. For instance, the S&P 500 is simply a list of roughly 500 of the biggest U.S. companies. We're talking the tech giants, the major banks, the brands currently sitting in your kitchen pantry. With one click, you own a tiny slice of all 500 businesses. If one company in that basket collapses, it's just a scratch, not a mortal wound. And if one happens to become the next global giant, well, you already owned it. It's like, instead of sweating and trying to pick the winning horse, you're just buying the entire racetrack.
Section 2. The 90% rule. Why professionals keep losing. Let's pivot for a second to a really stark reality that completely challenges everything Wall Street markets to beginners.
Now, this is a data point that often sounds completely fake to new investors. 90%. Every single year, a scorecard called SPIVA ruthlessly tracks the performance of highly paid professional fund managers and compares them against simple index funds. And the result? It is brutal, it is consistent, and it is undeniably clear. Across 15-year periods, roughly 9 out of 10 actively managed U.S. stock funds fail to beat the plain, boring index. Think about that. These are people whose entire full-time job is to beat the market, and 90% of them lose to a piece of paper that does nothing. It's an absolute slaughter.
And this brilliantly illustrates the mismatch here. On one side, you have these Ivy League professionals. They've got the Bloomberg terminals, massive research teams, and of course, they charge extremely high fees. But the thing is, markets price new information incredibly fast. Trading costs a lot of money. And well, being human means eventually dealing with panic and overconfidence. On the other side, you have the boring index. It requires zero decisions. It never panics because, well, it has no feelings to hurt. And mathematically, it just dominates over a 15-year stretch. Even the very few pros who do manage to win a given decade show almost zero persistence, meaning yesterday's winner is really no more likely to win tomorrow.
Section 3. The villain, the silent six-figure leak. Which brings us to the true antagonist of this explainer, the microscopic leak that quietly steals your future without you ever even noticing.
You see, every fund charges a yearly fee, which is known as the expense ratio. Index funds charge almost nothing, usually right around 0.05%, simply because managing a static list requires no genius. Actively managed funds, on the other hand, often charge around 1.5%. So I want you to ask yourself a question. Does a seemingly tiny fee difference of about 1% actually matter over the course of your life? Now, what's really interesting here is the devastating math behind that tiny percentage. If you invest $500 a month for 30 years at a 7% average return, that 0.05% fee leaves you with roughly $590,000. But with a 1.5% fee, investing the exact same money into the exact same market, you end up with about $440,000. That is a visceral $150,000 gap. Fees compound just like returns do, but in reverse. They quietly eat a house-sized hole in your returns. When you're sitting in a branch and a smiling bank advisor offers you their in-house managed fund at a 1.5 or 1.8% fee, you really have to realize you are the product.
Section 4. The Minefield. 4 Investing Red Flags. Let's act as your financial tour guide for a moment and walk into a museum of psychological traps. These are the exact traps that cause regular investors to sabotage their own wealth. All right, here are the 4 major investing red flags that separate successful investors from the ones who end up quitting. Number 1, stock picking hype. So your cousin tripled their money on a random tech startup? Cool, casinos have winners too, but they definitely don't disprove the house odds. For every loud winner you hear about at a dinner party, there is a silent graveyard of losers. Number 2, timing the market. Waiting for that perfect crash to buy in sounds like genius on paper, but nobody rings a bell at the bottom. Missing just the handful of the market's absolute best days over decades drastically kills your total returns. And get this, those best days usually cluster right next to the worst ones. Remember, time in the market beats timing the market. Number 3, meme investing. If you're buying a stock just because a subreddit is euphoric about it, you aren't investing. You're arriving late to a party where the exits are already packed. And finally, number 4, high-fee managed portfolios. A lot of the time, these are just incredibly expensive, flashy wrappers around the exact same boring indexes we've been talking about this whole time.
Section 5. The resolution, the boring plan that wins. So, let's shift away from the traps and introduce a rock-solid, actionable blueprint that absolutely anyone can implement to avoid those landmines entirely. Let's move to the next phase and see how this builds into a foolproof 4-step system. Step 1. Control your high-interest debt. You have to kill this first. Why? Because no index fund reliably beats 24% credit card interest. It just doesn't happen. Step 2. Build a cash cushion. Fund an emergency account so that when market crashes do happen, you're never forced to sell your investments in a panic just to fix a broken car transmission. Step 3. Buy a broad, low-cost index fund inside your country's tax wrapper, whether that's a 401k or IRA in the US, an ISA in the UK, or superannuation if you're down in Australia. Just ensure that expense ratio is sitting comfortably under 0.3%. And finally, step 4. Automate it. Set up a monthly buy. Rain or shine, up markets and down markets, you buy every single month. Down months don't mean you panic. They just mean your money is buying more slices on sale.
So the crucial point to understand is this: simple does not equal easy. This strategy is incredibly simple to understand logically, right? But the hardest step for human psychology is to set this wealth machine up and then do absolutely nothing for decades. No tinkering, no checking your portfolio daily on your phone, no reacting to whatever the panic of the week is on the evening news. In fact, legend has it that the absolute best performing accounts at major brokerages belong to people who literally forgot they even had them.
Which leaves us with one final, pretty provocative challenge. You now possess the exact blueprint to mathematically beat 90% of highly paid Wall Street professionals. The boring plan is what wins. But are you disciplined enough to do the hardest step of all? Absolutely nothing? That is the real test. Set up your automation today, let the index do the heavy lifting, and step away. Thanks for joining me on day 6. I'll see you in the next one.